Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look at some of the top earnings for the week starting Monday, the 13th of May. And certainly this is a week that's going to be dominated by retail. We have seen the vast majority of the S&P 500 having reported already. And so the question mark is, what is left? Well, let's look first and foremost at the performance of different sectors thus far. What we can see here is that by and large, we have seen outperformance, but it's been relatively mixed. You can see particular underperformance in terms of utilities, really on the revenue side of things, basic materials also underperforming from that perspective. Certainly earnings faring better than revenues. That is typically a trend that we see throughout earnings seasons. But the question mark really for this week is all about that consumer cyclicals versus consumer non-cyclicals. So let's look at that. So consumer cyclicals essentially is discretionary purchases where you're looking at things that people can essentially write off when times are bad. And certainly given the fact that we've seen elevated borrowing costs, higher interest rates, higher inflation, that does point towards people potentially tightening their belts and potentially looking for alternatives. Now, we have just seen a report from Adobe Analytics that did note a 7% rise for the first 4 months of this year in terms of online purchases in the US. But what they have seen is that people are trading down for items and substitutions that are cheaper. So people are trying to maintain their quality of living, being able to buy essentially the same things, but they're not willing to pay the same amount for it. And so they will get the cheaper alternative for it, which by and large probably increased in price to the extent that they're probably paying not that much less than they were previously for the better item. But nonetheless, that is a key theme going forward. So people are looking for those cheaper purchases. If you're looking to buy a retailer, they're the kind of company that would provide those cheaper alternatives. Take Tesla, for example, right? Of course, that's not necessarily within this retail space, but you're looking at a company that has really been making its name off the back of a very premium brand. But now markets and traders are really looking for them to hammer home this idea that they're going to provide a cheaper alternative, because it comes down to cost at the moment. And that pressure in terms of the competitive environment really does mean that some of these big names need to provide a cheaper alternative to maybe some of their more expensive products that have risen in price over the past couple of years. So in terms of consumer cyclicals, what we can see here is we've seen underperformance in terms of revenue. So 50% of those reporting thus far have fallen short on revenues. 75% have beat on earnings. So certainly, like I said, better on that side. But if you look across the board, you know, it's somewhere in the middle. It's not necessarily great in terms of cyclicals. But the non-cyclicals, so this is essentially the staples where people have to buy them. They have done much better, which really is to be expected, really, because these are the kind of products that people can't do without. So you're seeing 88% of these companies beating on earnings, 71% beating on revenues. Let's look at the three companies that I'm picking this week, and we'll pick through it from that perspective. And the first of those is Walmart. Now, Walmart reports on Thursday, and this is a company that I would say by and large falls within the staples category. So they provide a number of basics. They provide a whole host of products, bearing in mind they're the world's biggest retailer, but they do provide those basics, and they have been willing to push out in terms of creating a sort of cheaper own brand alternatives as prices have gained ground. And the company has done very well off the back of that. If we're looking in terms of expectations, 0.51, so 51 cents expected on the earnings per share. You look back to the last time, so Q1 of 2023, 0.49. So expecting to see marginal improvement in terms of that EPS number, and then revenues 159.4 expected versus 152.3. So gradual improvements expected. Bear in mind that generally it's typically Q4 that you do very well in the sort of retail area where people buy around Christmas. And certainly that's most notable for the likes of Apple, where they release their new products and their new iPhone, and therefore everyone rushes out to buy it over the Christmas period, then it dies down at the beginning of the year. So we're expecting to see a decline in terms of revenues versus the fourth quarter, but that's not necessarily a surprise. So you've got to do sort of year-on-year comparisons for this. So what's the company doing in terms of its share price? Well, this has been a big outperformer. We can see here in terms of the weekly time frame exactly that. Now, we've seen some consolidation as markets do weaken. You can see, if I was to overlay the S&P 500, for example, you'll see that we did see this pullback in terms of the S&P. Let's just put both of them on the left, and then I want to put it as 8%. So let's see what's happened in terms of this stock versus the S&P 500. By and large, since the beginning of this year, you can see that Walmart has largely outperformed against the S&P 500. But by and large, this is tracking it relatively well. You can see that the sort of correlation between the two is relatively strong. You can see there you go. So as we move closer, it's sort of tracking that S&P 500 trajectory at the moment. So you look for stocks that kind of outperform the S&P 500. You look for companies that underperform the S&P 500. By and large, I would say that this is a company that has been a very strong performer alongside the S&P 500. So this is a key component within the index. And by and large, it has been largely tracking it as it essentially tracks sentiment within the US economy as a whole, which by and large would then translate in terms of a view on how the US consumer is faring. What have we seen recently? Well, we've seen the breakout from this consolidation pattern with a rally up through this near-term swing high, which came, let's just move that to the right. And then, yeah, regular. There you go. So we've got 60.53 as that swing high. We've rallied through it, selling off from there. So, you could say, oh, this is a fake out. Well, perhaps, but I think there's a good chance that what we're seeing at the moment is the pullback. We've seen before the bulls come back into play. So we've seen this pattern here, right? Let's just get the line on. So you're seeing the pullback into the creation of lower highs and lower lows, right? Then we see essentially flatlining lows there. And then we've now seen a rally up through resistance. So there's a good chance that it goes something like that. Essentially, we've rallied up through resistance. So it points towards near-term weakness and then a possible bull run. Certainly, if we see a breakdown through this recent swing low that was at 58.58, then it looks like this pullback is set to continue. But that rally up through 60.53 does give us greater confidence that that is over. And therefore, it's just a question mark of, how long is this pullback going to come into play for? We don't necessarily know. We can sort of draw our conclusions in terms of whether this is a retracement before we rally or whether this is a retracement before we sell off through support. But we don't necessarily know whether this is going to retrace into a deep move, a shallow move, or alike. Now, of course, we have got to wait until this earnings report, and that could be the catalyst. But certainly near term, there is a possibility of further weakness, but ultimately we'd need to break the 58.58 to negate that rally up through 60.53, which appears to mark a turning point for this stock that has been a big outperformer. We've been largely consolidating here. So the trend is very much your friend, and the trend still remains in play despite this sort of period of consolidation that we have seen of late, with the rally up through 60.53 giving us greater confidence that we will move higher from here. Price to earnings ratio around about the 32 mark. You can see from a sort of historical standard, we're sort of somewhere in the middle of the range that we have been seeing. But it's notable if you're looking at, say, 32 price to earnings ratio, the next one we're looking at is Home Depot, and that is roughly sort of 23. So attaching a very different valuation here. So let's look in terms of Home Depot and look at exactly how things are stacking up for this company. So here's the breakdown in terms of market expectations. We're looking for 360 on the earnings per share figure, an improvement on the fourth quarter as we start to build once again. That is by and large the pattern that we have been seeing here for this company. Of course, like I said, a lot of companies, a lot of retailers really do well at the back end of the year. But this is not necessarily one of them. Generally, the back end of the year, of course, is sort of winter time. And with Home Depot, you're talking about DIY, you're talking about garden work. And a lot of the time that sort of dies down over winter, more so coming into spring, coming into summer. That's when people really want to start making home improvements and the like. So we're expecting to see a pickup. If you're looking at the comparative versus last year, we're expecting to see a decline this time around in terms of 360 versus 382 for Q1 of 2023. And then in terms of revenues, 36.64 expected, down from 37.26. So again, some potential concern and a sort of weakness in terms of those spending habits. Questions around whether they have really provided enough value for money. And the problem here is that retail sales have moved upwards in terms of value, but we've reached a point where people have got fed up of continuing to spend more and more and more and receive less and less and less. And therefore, people start to curb some of their spending unless they are products that they really have to purchase. And of course, like I said, this is more the consumer discretionary side of things or the cyclical side of things. And that's the area where you're likely to see people sort of cut back compared to the staples. In terms of the share price, like I said, we have a lower valuation attached to it from a price to earnings perspective. Let's go out in terms of long term. So this is the weekly time frame. You can see here long term uptrend in play. We saw that COVID sell off, but ultimately everyone just jumped out and started making home improvements. So we saw a big rally up into that peak here in late 2021. Then we saw the pullback, and this does look like a bottoming pattern that we saw throughout the back end of 2022 and through much of 2023, with the rally up through that resistance level here. There you go, of 338, essentially marking the end of that, what looks like a potential sort of triple bottom formation, but essentially it's a bottoming pattern with flatlining highs and near enough flatlining lows. The rally up through that area of resistance between your sort of 338 and 346 pointed towards a resumption of that bullish trend. But we've seen this pullback at the beginning of this year. And like I said, we're looking at, how are these stocks performing versus the market? So again, let's get that drawn up against the S&P 500. You can see very clearly that this is a stock that has really underperformed versus the S&P 500. S&P 500 not necessarily too far off its record highs. Well, look at how far we have fallen in terms of this stock. In terms of the decline from the peak, we can see we're down 13% here. So with the fact that we've dropped down into what was a breakout point, and now we're back into this sort of 50% mark as well from a retracement perspective, the question mark here is that over? And from a sort of technical standpoint, there is a decent chance that could be the case. Just get rid of this volume here. And so what you're looking at here is a trend that has really been playing out with this creation of low highs, lower lows. That rally up through your first swing high here at 340 points towards the possibility that this rally is going to create a higher low and push higher once again. Well, that seems to be what's happened. And we're regaining ground once again. Now, Home Depot report on Tuesday, so there's a bit of time until the company reports its latest earnings, but there's a good chance that we are setting up for another push higher here. It really comes down to exactly how they perform in terms of earnings and the outlook for the year ahead. Of course, the perspective in terms of interest rates does remain concerning, given the rebound in terms of inflation over recent months. But nonetheless, we're looking at a stock that has been hit relatively hard. We look like we possibly bottomed out here with the rally up through your intraday swing high, the pullback now giving way to a bullish move higher here. So for a sort of buy and hold perspective, I'm sure some will see this as an opportunity because, the US consumer has generally shown itself to be relatively strong throughout this period. And therefore, once we move into that phase where suddenly we're seeing interest rates being cut, that should provide a fire under some of these cyclical stocks as the expectations for growth improve. Nonetheless, for the near term, we're looking at for potential volatility. If we come into that deeper retracement here between your 61.8, which is at 321, and your 303, which is, 76.4, which is at 303, that could be a potential bottom as well. But at the moment, we are showing signs of a bottom, but we have, of course, got the impending report from Home Depot to throw a spanner in the works or aid this recovery for a company that really has been sort of underperforming against the S&P 500. And then finally, let's look at things from a different perspective, and that is Alibaba. So we're looking at things from a sort of Chinese perspective here. And there, of course, have been major concerns around the Chinese economy, the growth picture, the borrowing, the over leverage, the real estate market. There are a lot of big question marks in China. And that's why so many of the Chinese stocks have been hit hard. Now, the big caveat also to any of these US listed Chinese companies is the fact that we have got Donald Trump that in my mind is likely to get into the White House later on in the year. Of course, there's a big question mark over who will come into power. But I think there's a strong chance that we see Donald Trump get back into the White House. And what does that mean? Well, that means that we might see another breakdown in terms of US-China relations. If anyone follows the markets keenly and watches the news regularly, they will know that the period where Donald Trump was in power was essentially just dominated by daily talk and fears over the relationship and breakdown of trade between the US and China. And so Alibaba, of course, will likely suffer if that comes into play once again. In terms of the outlook for this share, you're looking at 142 for the Q4 financial year earnings. That's down from the 156 in the same time last year, then 30.5 billion versus 30.31. So expecting to see a decline year on year for both revenues and earnings. And so, there's a question mark about whether this is going to point towards continued weakness in the region, or is this going to set us a low bar for us to be able to see outperformance for this relatively beat up name? Well, look, you're talking about whether it's oversold or beat up. Certainly, this is a company that has had its highs and had its lows, and we can see that exactly here on the weekly time frame. It's certainly more at its lows than its highs at the moment. This is the long-term perspective. Actually, I'm going to go on the monthly time frame and show you exactly why this is interesting. You can see this massive roundabout journey, the rally that we saw up into the peaks here in 2020, and it's really been capitulating since then. Of course, we had the zero COVID policy in China, which means that businesses in China really suffered more than most, as we're seeing the sort of deleveraging and the removal of risk in the Chinese economy, but that also had dense growth prospects for the region as well. In terms of the sort of long-term picture, though, you can see from a valuation perspective, we have come back down towards this area that we saw back in 2015 that ultimately set off that massive rally. Now, where are we in terms of the price to earnings ratio? Well, back then you were looking at sort of 16.5, something like that, 14, 16, and we're at a similar kind of picture now. There you go. So yeah, we're around about 14 to 16. So it's a tough one. I mean, look, ultimately, this got to be a question mark around the expectations for the Chinese economy going forward. There is an expectation that soon enough they'll get their act back together. But it's a question mark. And certainly with the concerns around how things might shape up between Donald Trump and China if he comes back into power, that adds another concern for investors going forward. So this is the weekly time frame. But what is notable is that we've rallied up through this trendline resistance. Does that mark the beginning of a bull run for this market? Well, I would say that we have broken out from this near-term trend that has been dominating over the past year and a bit. But I would also say that, unless we see a rally up through this swing high that we have here at 87.83, there's a good chance that the gains that we've been seeing essentially just mark a retracement phase. If I put the Fibonacci on here, you can see we're rallying up into that 76.4 Fibonacci level, which is at 82, essentially 82, 81. So there's still significant question marks. But if we do see these earnings beat and they provide a more sort of upbeat or positive outlook going forward, 87, 83 is really the key level for us to look out for, that if we're going to break through that level, if we're going to provide a sort of more bullish outlook for the longer term. That's going to be the key hurdle up ahead for this stock. But certainly you've got to say your trend is your friend. You could say, well, that trend's over because we've rallied through trendline resistance and through your near-term swing high. But ultimately you do have trends within trends. And so it's also a case of them breaking through your wider swing highs that are evident on, say, the weekly time frame and the like. So there's still some significant questions to be answered for Alibaba. It doesn't only rely on the Chinese consumer, it also relies on the outlook for the Chinese economy relative to the US and the possibility of trade between China and the US going forward. Of course, we've got question marks about the whole Taiwan issue. Is that going to flare up at some point and then dent these stocks further? Big question marks for these companies. But certainly we're talking about one here that if you look at that in relation to, I mean, you're talking about price to earnings ratio here of 14. We were looking for Walmart of a number closer to 33. So certainly from a valuation perspective, markets are pricing in a significant amount of risk. That does make sense, quite frankly, given the concerns around the Chinese economy, given the concerns about the relationship between the US and China and how that might progress going forward. But certainly, as I noted at the beginning, consumers at the moment really focusing on value. And it's a question mark of whether these businesses can fill that gap and take advantage of that desire to push for a cheaper product to maintain the standard of living following a period that has seen rampant inflation around the world, less so in China. I hope this helps. Good luck with trading over the week ahead. But certainly, as we move through into the final 10% of the S&P 500's earnings season, it has been a relatively mixed bag, but there is a feeling, as I highlighted right at the beginning of this earnings season, that we will gradually over the course of this year see a realignment where people aren't necessarily so heavily geared towards the tech sector and instead looking for that economic rebound as we move out of 2024 and head towards a 2025 that is expected to be much more bountiful when it comes to economic growth.